Good morning everyone, this is Amit Pabari, founder and managing director of CR Forex. On last week's video, we discussed that the pair has entered into a consolidation phase between 80.80 on the lower side and 81.50 to 81.80 will act as a strong resistance for the pair. But the biasness of the pair is on the stronger side and any uptick should be used as a selling opportunity. Exactly the same has happened. Now the big question is, where is the current trend going? कहते हैं trend is your best friend and the current trend in the dollar rupee pair is on the stronger side, and there are two important reasons for the same. On the domestic side, we are getting inflows. Next week maybe there are inflows lying up in terms of Adani IPO and RBI green bonds. And on the international side, as we have discussed in our previous video, that US data is coming on a weaker side, because of which dollar index is falling and emerging market currencies are appreciating. Second big reason is lower crude oil price, that is also supporting the dollar rupee pair. But the question is whether the trend will continue to be on the lower side or not. To understand that, let us understand what RBI will be doing in coming days. If you see the chart, you can understand that in the month of November, when dollar rupee pair went to 80.50, at that point of time, RBI have drawn it Laxman Rekha and bought dollar aggressively and did not allow dollar rupee pair to fall below 80.50 level. And it is supported by the fact that RBI forward book have increased close to $8 billion between October to November, and during that period of time, rupee supported at 80.50 and went to 81.60 to 81.70 levels. Now let us conclude what is the view on dollar rupee pair. The primary trend of rupee is on the stronger side, and there is a high possibility that the pair can move towards 80.50 to 80.80 level in coming days. But we have to be alert that at what level RBI will intervene and buy dollars. Important support for the pair is near 80.50 to 80 area, and important resistance for the pair is close to 81.50 and 81.80 area. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporter. Most of them must have taken costing between 81 to 81.20. We suggest two ideas to them. They should keep a stop loss of 81 and wait for a bounce back towards 81.20 to 81.40, where they can cover 100%. If on Monday morning the pair trades below 81, then they should not wait. They should simply go and cover 100% on a back-to-back basis, because if pair breaks 81, then there are higher chances that the pair can move towards 80.80 and 80.50 in coming days. Now let us discuss strategy for thick margin exporters like textile or an engineering exporter. When the rupee is trading between 80.50 to 81.30, ideally they should use forward, which they have booked at higher level. For new booking, they should wait if RBI intervenes, and because of that, if the pair gives a bounce back towards 81.50 to 81.80 level, they should use that opportunity to increase their hedge ratio. And third important point to note is, at any point of time, their hedge ratio should not fall below 45%. Now let us discuss strategy for importers. Technically, when rupee is appreciating, importers' life is easy, and so is my strategy. Very simple. Cover 50% of your imports for the month of Feb between 80.50 to 81.20 level. For medium term imports, just wait with a stop loss of 81.50. If 81.50 is broken, then we will decide whether to cover more or not. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.